My name is Tony Lajeunesse, President and CEO of TL Financial Group. Today's video is a special update regarding the recent market volatility related to the coronavirus. So it's now clear that this virus has escaped the attempted containment by Chinese authorities and has spread around the world. According to the World Health Organization, there are 79,331 confirmed cases, of which 77,262 are in China. And then there's 2,069 are outside of China, and that's as of February 24th. The two largest country clusters are in South Korea with 232 and Italy with 64. And many of those numbers seem to be on the rise, with the Washington Post reporting on February 24th that there were 833 confirmed cases in South Korea and 53 confirmed cases in the US. So what has the market reaction been? On Monday, global financial markets were down by 3% or more, and here in the US, they were down by almost 5% from their peaks. This drop is one of the largest in recent months, and reflects a sudden apparent surge in cases over the weekend. Investors are clearly expecting more bad news, and rather than wait for it, they are selling. So is selling, though, the right thing to do? Probably not. Indeed, the virus could continue to spread and even get worse, but we do know a couple of things. First, new cases in China seem to be leveling off, having been peaked from January 23rd to February 2nd. We can expect things to get worse in countries with new outbreaks, but steps can be taken to help control the virus, as been shown in the origin country. Second, countries have been applying the lessons learned from China to their own outbreaks, which should help contain their outbreaks. For example, the Centers of Disease Control and Prevention reports that 14 cases diagnosed in the US, as well as 39 cases in people repatriated here from China or the Diamond Princess cruise ship. Cases here appear well contained and under surveillance, which really should help limit any spread. The same holds true for most of the other developed countries as well. For all the hype then, in many countries, and certainly in the US, the coronavirus remains a very minor risk. Another way to put that risk in context is that during the current influenza season, there have been 15 million cases reported, 140,000 hospitalizations, and 8,200 deaths. Compared with the average flu season then, the coronavirus really doesn't even register. With 53 current coronavirus cases, it could certainly get worse. At least in the US, however, the overall damage is not likely to come close to what we already accept as normal. So let's assess the investment risk. While the risk to your health may be small, that may not be the case for your investments. The epidemic has already caused real economic damage in China, and it's likely to keep doing so for at least the first half of the year. The same case seems likely for South Korea. These two countries are key manufacturing hubs, so any slowdown there could easily migrate to other countries through component shortages, crippling supply chains around the world. Again, there are signs in the electronics and auto industries that the slowdown is already happening, which will be a drag on growth. And this risk is largely behind the recent pullback in global markets. So here the key will be whether the disease is contained, which would still be a shock to the system, but would be normalized fairly quickly, or whether it continues to spread. Right now, based on Chinese data, the first scenario looks more likely. If so, Chinese production should recover in the next 6 months, with the economic effects passing even more quickly. It might help to think of these situations like a hurricane, where there is significant damage that passes quickly. Stock markets, which typically react quickly on the downside, can bounce back as quickly as well. Should the virus be contained, it would be a mistake to react to the current headlines. So we've seen this situation before, the drop and bounce back, with other recent geopolitical events. So what if the virus, though, continues to spread? Even if the virus does continue to spread around the world, those in the U.S. should take a deep breath. The U.S. economy and stock markets are among the least exposed to the rest of the world, and they are the best positioned to ride out any storm. Further, the U.S. healthcare system is among the best in the world, and the CDC is the top health protection agency in the world. As such, we are and should be relatively well protected. Finally, given that the U.S. economy and markets depend primarily on U.S. workers and their spending, we're really less vulnerable to the epidemic. We should do relatively well, as has happened in the past. With all that said, though, what is the proper course of action? The headlines are scary, and Monday's markets declines even more so. But the economic foundation remains reasonably solid around the world. The epidemic is a shock, but it's not likely to derail the recovery. The World Health Organization, while recognizing the risks, has not declared a pandemic, indicating that the risks remain contained. The U.S. is well positioned, both for the virus and for the economic effects. So we certainly need to pay attention, but as for now, watchful waiting really continues to be the proper course of action at this time. Once again, try to remain calm during this volatile time. Please know that we continue to monitor the economic data and know that we're here for you if you have any questions. Thank you for watching. Again, if you have any questions, please feel free to reach out to our office. Thank you very much.